Have you ever looked at a company's earnings report, maybe a big tech firm, and seen them post these massive profits, but then you notice they're not really generating much cash? Well, the culprit is often one single, kind of sneaky line item: stock-based compensation. Today, we're going to pull back that curtain and figure out what this thing really is and what it really costs.
And that gets us to the big question, right? The one we're here to answer. Is paying people with stock a real, actual cost to the business, or is it just some, accounting trick that we can safely ignore? The answer, you'll see, has huge implications for how we figure out what a company is truly worth. So let's get into it.
Okay, so first things first, let's get on the same page. What exactly are we talking about when we say stock-based compensation?
So, according to the official rulebook, what we call US GAAP, SBC is an operating expense. It's supposed to be treated just like cash salaries or the rent for the office. And it's a super powerful tool, especially for younger companies where cash is tight. Instead of a huge cash salary, they can attract top talent by giving them a piece of the company itself. Now, this stuff usually comes in two main flavors. First, you've got restricted stock. That's where you're given actual shares of the company, but there's a catch. You have to wait for them to vest, meaning you have to stick around for a while before they're really, truly yours. Then there are stock options. These are a little different. They don't give you the stock itself, they give you the right to buy the stock at a set price down the road. It's basically a bet that the stock is going to go.
So, if the official rules say it's an expense, end of story, right? Well, not exactly. And that's what leads us straight into this huge accounting debate, the difference between the rules and the story companies want to tell.
See, on one side you have GAAP. That's the official rule book, what the SEC requires. And it says SBC is a cost. Period. It reduces your net income. But then you have this other universe called non-GAAP. This is where companies get to create their own customized numbers. And one of the most common things they do is add that stock compensation expense right back in, claiming it's non-cash and doesn't show their core business performance. They're telling you a different, often rosier, story. This wasn't always such a battlefield. Before 2006, a company could hand out stock options like candy, and it wouldn't even show up on their main profit statement. Then the rule makers, a group called FASB, stepped in and said, "Whoa, hold on, you have to count this as an expense." But what happened? That just fueled the rise of non-GAAP, where companies basically found a new backdoor to show you the number they wanted you to see.
And make no mistake, this isn't some fringe tactic used by a few scrappy startups. A whopping 97% of companies in the S&P 500 now use non-GAAP numbers in their reporting. Just let that sink in. For pretty much every major company out there, the adjusted profit is the headline number they want you to focus on.
Okay, so this brings us to the really important part. As an analyst, or just as a smart investor, why should you care about all this accounting jargon? Why does this debate actually matter?
Well, let's do a little thought experiment. Imagine these two companies. They're identical in every way, except one pays its engineers 100% in cash, and the other pays them mostly in stock. Now, if you look at the non-GAAP numbers and just ignore the stock expense, that second company is going to look way, way more profitable. But is it really? See, this is the problem. It makes it almost impossible to compare two businesses on a level playing field.
NYU professor Aswath Damodaran, one of the sharpest minds in finance, just nails it here. He argues this isn't like depreciation, which is just an accounting entry for a machine you already bought. Paying with stock is a barter deal. The company gets valuable labor, and in exchange, it gives away something incredibly valuable: ownership. And that giveaway has a very, very real cost to the existing owners. And that cost is called dilution. It means your slice of the company pie just got smaller.
And this is where the rubber really hits the road: valuation. Because this one little accounting choice, whether to count SBC as a cost or not, can have a massive, dramatic impact on what people think a company's actually worth.
So here's how it usually works in practice. When analysts build a valuation model, a really common one is the discounted cash flow, or DCF. And in that model, they try to project all the future cash a business will generate. And what's one of the first things they almost always do? They add back stock-based compensation because, hey, it's non-cash. But in doing that, they're completely ignoring the future cost of that dilution to shareholders.
Let's just put the two approaches side by side. The typical way you see on Wall Street is to add back that SBC expense. This makes the free cash flow look bigger, which makes the company look more valuable. But the more conservative, and I'd argue more correct approach, is to not add it back. You treat it like a real cash expense, which gives you a lower but much more realistic picture of the cash flow that actually belongs to shareholders. And what's the result of these two different methods? Is it a small difference, a rounding error? No way. Look at this. For the exact same company, the typical analyst approach might value it at over $42 a share, but the conservative method, the one that properly accounts for the cost of SBC, it comes out to just over $30 a share. That is a nearly 40% difference in perceived value, all because of one single accounting choice. That's huge.
Okay, so now that we know how big of a deal this is, what can you actually do about it? How can you look at these companies and not get misled? Let's build out your toolkit.
All right, here are the key things to drill into your brain. Number one, and this is the most important, treat stock-based compensation as a real, legitimate economic cost. It's not free money. 2, always dig into a company's filings and find the table where they show you how they got from their official GAAP number to their custom non-GAAP number. They have to show you the math. 3, be super critical of any valuation model that adds back SBC but doesn't then account for the dilution on the back end. And finally, just remember the basic trade-off. Companies need great talent, for sure, but paying for it with stock is a real cost that is borne by the owners, the shareholders.
So I'll just leave you with this to think about. The next time you see a headline screaming about a company's record-breaking adjusted profits, take a second and ask yourself, what is the true cost of getting there? And what story are those hundreds of millions of dollars in stock grants really telling you about who's paying the price for that growth?
This is not financial advice.